What if I told you you could combine dividend income, passive income, with passive covered call income, all in one beautiful ETF? That's actually done pretty well in the past 5 years. Well, look no further than the Amplify CWP Enhanced Dividend Income ETF. Now, high-yielding investments have become very, very popular with a lot of investors that are seeking passive income because treasuries, at least up till recently, have not been paying that well. Now they are, but in the past, they were not paying that well. So if somebody wanted a high yield, they couldn't put their money in a savings account because until recently they weren't paying that much. They couldn't buy treasuries. There was really not much out there to generate high yield. But then people considered that, hey, I could buy a dividend-paying investment that also writes covered calls, which is a contract that generates income to the investor. So let's go ahead and investigate the Amplify ETF DIVO that I've been hearing so much about. What is in this ETF? Because when you look at stuff like this, you at least have to dig into the details. You have to at least understand what you're investing in and some of the risks and some of the potential rewards. So here we have DIVO, ticker symbol DIVO, trades on the New York Stock Exchange ARCA and has net assets of almost $3 billion and a total amount of holdings of 29. Now, my personal favorite investment, the Vanguard Total World Stock Market Index ETF, has a total of, 7,000 stocks or more. It is insanely diversified. It's basically every stock in the world at market cap weights. DIVO has 29 stocks, so you should at least understand that there really aren't that many companies in this ETF. Also, the expense ratio is not crazy, but it's definitely higher than a normal index. You could buy the total U.S. stock market, VTI or VOO, for 0.03%. So this is, 15 times higher of an expense ratio than the total market index. So you get less diversification, much less diversification, and you get a much, much higher expense ratio. But what are some of the benefits? Why would you do this if the expense ratio and number of holdings were so radically different from a total market index? Well, you have income potential comprised of high quality, which is subjective, dividend-oriented stocks along with covered calls on individual stocks. Dividends are a company's accumulated profits that have been distributed to shareholders. Companies have cash on their balance sheet. They don't really have any ways to invest it to get a good return or a high enough return to justify investing the money. So instead of keeping the cash just sitting on the balance sheet, they give it out to the shareholders. That is a dividend. When a dividend is declared, that reduces the equity of the company. And when the dividend is paid out, that also reduces the, if you think about it, the actual value of the company. Because the dividend, the cash, is leaving the company. It's going away. It's left the company. So the company's value drops by the amount of the dividend. Covered calls, like I said, are a contract where you own a basket of securities or you own some type of security, and you enter into a contract where you give somebody the right to buy your shares from you at a certain price in exchange for that person paying you a premium. That's the income. That's what this ETF is doing. It's buying high-quality subjective dividend stocks, and the fund managers are writing covered calls to generate additional income on top of the dividends. Active management allows the portfolio manager to identify opportunities and risks and act on those decisions in real time. Now, active management can be a blessing, and it could be a curse. Why is it a blessing? Well, if you have a hotshot fund manager, let's say you had Warren Buffett, genius, or you had Peter Lynch, they could potentially crush the market. It's happened before. I can't deny that. Even as an index investor, I can't deny that some people have crushed the market consistently for long periods of time. But there's also disadvantages because an active manager, while they could do well, they could also make massive mistakes. And it only takes one error, one snafu, one disaster to absolutely implode an ETF. That's the risk that you're taking by trusting an active manager. You need to really look into these managers, see if they're actually good at what they do, and even if they are good at what they do, there's a potential that in the future they could still potentially make a mistake. That is an additional layer of risk that is there when you're investing in an actively managed ETF versus a passive ETF. Seeks to lower volatility. Dividend and option income may provide lower share price volatility versus the overall market during times of broad-based market declines. So it seems like when markets are going down, which they are, this is kind of an appealing ETF because you're still generating income and you're minimizing volatility. You're not seeing your investments plunge. That's some of the good stuff, right? What are some of the drawbacks? Well, there's some drawbacks of covered call ETFs. And this is from The Street. Investing in covered call ETFs has several disadvantages, including upside potential is limited. ETFs' use of selling call options to generate income restricts the possibility of capital growth. This may be a drawback for investors hoping for potential growth in their investments. Why is that? Well, if a stock suddenly shoots up and you have a bunch of contracts that you've written, people can, and you are obligated to sell the shares that you own at the strike price. You must sell those shares. So in a sudden bull market, which the market can turn on a dime, boom, you could have your shares ripped from you, and you actually miss potential gains, even though you generated some income. There's also limited downside protection. The fact that covered call ETFs might not offer much downside protection as conventional stock ETFs is another disadvantage of these funds. Even if the ETF is making money by selling call options, the value of the underlying assets could still decrease. 100% true. You could buy, I'm trying to think of a stock. You could buy AMC, right? Highly volatile stock. And you could write covered calls against AMC, but AMC can still collapse 80, 90, even 100%. It's happened to companies before. So even though you're generating income, if you buy a company that suddenly collapses at a massive scale, well, guess what? You're going to lose money, okay? And last, it's dependent on volatility. Call option sellers can earn a profit depending on how volatile the underlying assets are. Because options premiums will be low in a low volatility environment, the ETF will earn less money. So when there's a lot of volatility, great, you're going to make so much option premium income. When volatility is lower, you're not going to make as much. So it seems like there's not much greatness here. There's limited upside potential and limited downside protection. What's the amazing benefit here besides getting that income, which I guess makes some people feel good about themselves? Okay. Now, to look at the underlying holdings, they have income from dividend paying stocks, and they opportunistically, based on the fund manager's judgment, write covered call options. Now, their stated goal is to provide gross annual income of approximately 2 to 3% from dividends and 2 to 4% from options premium. So you could get between 4 to 6% income from dividends and option premiums. But remember, the market has historically returned 10% in the past. Doesn't mean anything about the future. And this is just the stated goal of the ETF. Now, some of the larger companies. So here it says there's 24. So maybe this is more updated than the main page. But the top 10 holdings are United Health, Chevron, Home Depot, all very solid, great companies. Can't knock on them. Nothing wrong there, okay? And they're not at such massively concentrated weights that, you know, if one of these companies goes down in flames, you're going to lose too much money. I've seen other ETFs that have way more concentration, okay? So overall, I mean, the holdings, I've seen worse companies in a portfolio. But overall, I mean, the fund has done well. But you have to remember, past performance is not indicative of future performance. This ETF is very concentrated in one country in a certain sector of stocks, basically large cap value dividend payers. And while this may do well during a volatile bear market, when we eventually get to a bull market, which we will, this may potentially underperform because that's just inherently in the nature of call options. Is if you have a bull market, you could potentially massively underperform because your call options force you to sell a lot of your underlying holdings and sacrifice some capital appreciation. A final thing that I noticed is portfolio turnover. So you want to check all this stuff. You want to check the fees, which, like I said, this is like 14, 15 times higher than a standard vanilla, total market index in the United States, at least. Then you want to look at portfolio turnover, which are transaction costs such as commissions when it purchases or sells securities. A higher portfolio turnover will cause the fund to incur additional transaction costs and may result in higher taxes, lowering your returns, when shares are held in a taxable account. These costs, which are not reflected in the total annual fund operating expenses, may affect the fund's performance. During the fiscal year ended October 31st, 2022, the fund's portfolio turnover rate was 87% of the average value. That means they're flipping in and flipping out a lot of investments, which could potentially increase transaction costs and taxes. So these are all things you need to consider, okay? At the end of the day, these things, they're, in my opinion, they're too risky. Okay, you've got to trust this management team to do well. The management could make a mistake. The whole time you're paying a pretty high expense ratio. You're really not owning any stocks, and you only really do well during a volatile environment, or a bear market. What's wrong if you're a long-term investor with just buying a total market index and just waiting for 30 years? That just seems like a much simpler path, in my opinion. But some people like the income. It feels so good when they get their little check deposit. I get it, okay? But at the end of the day, you may be potentially sacrificing or leaving some money on the table in the long run, depending on what happens with the stock market in the future. Hope you enjoyed the video. Hope you learned something about DIVO. And if you want to buy it, whatever, that's your choice. I'm personally not invested in it. Talk to you later.